Hey everybody, welcome to this free edition of our Traders Group Weekly Roundup. This is for the trading week ending July 10th, 2020. I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. We want you to be the red striped zebra. This week's theme is tic-tac-toe. Before we get into everything, let's just kind of take a look at where we've been in the markets and kind of where the weekly sound bites are. Just kind of a quick review. First up, let's look at the performance of the index. As you can see, the Dow was up almost 1%, 96 basis points for the week. The year-to-date performance a little under 8% for the year. S&P was up a little over 1.76% for the week. Year-to-date, it's almost break even. It's down about 1.42%. Nasdaq had a very strong week. But which week hasn't been strong for Nasdaq? More on that later, but it was up over 4% for the year. For the week. Year to date, it's up 18.33%. And the only one bringing in the red for the week and for the year solidly is the Russell. It was down 64 basis points for the week, and it's been down 14.73% for the year. If we look at the sector performance in the U.S. this week, the discretionary had the best. It was up 5.17%, and the worst was energy coming in at 4.34%. Then if we look at some of the world index performance, we can see over in Europe, the FTSE and the CAC 40, they were both down just slightly under 1%. The DAX was the only one up about 84 basis points. And in the Asian markets, Nikkei was really just slightly above. China up 7.31%, Hang Seng up 1.4%. Then, of course, if we get over here to U.S. valuations, the trailing 12-month PE ratio is at 27.95. The forward PE ratio is 25.14. So the forward 12-month PE ratio is lower than the trailing by about a little over 10%. The dividend yield is 1.94%. The 10-year Treasury's coming in this week at 63 basis points. So that gives us a spread of a little over 1.3% between the dividend yield and the S&P and the 10-year Treasury. So that continues to drive money into the U.S. markets. Of course, if we take a look at the weekly sound bites for next week or this past week, technology shares kind of leads the way. Thus far this year, it's up over 18%. As I said, Nasdaq saw its 23rd record close for this year. And we're getting other sectors that are more economically sensitive, like materials, utilities, and then real estate, basically flat for the year, up just a little bit, but not much for some. But in the same vein, we're also seeing gold move up. The prices we haven't seen since 2011. Okay. I will point out that the short interest in Nasdaq rose this past week, up 5.2%. So short interest is starting to build in Nasdaq, expecting a pullback. And we saw short interest in the New York Stock Exchange. There's about 4,400 companies or so in the NYSE. It rose 2%. And the top shorted asset in the New York Stock Exchange is the SPY, which basically is a tracking ETF for the S&P 500. So it's really amazing where we've been on this thing. Now, if we look at also the PMI data coming in, non-manufacturing PMI, which measures business conditions, it posted its biggest monthly gain yet. And it moved actually into expansion zone for this week. We've had really a string of positive economic surprises. However, we're seeing some new COVID-19 cases go up. We're seeing several states slow down or roll back some of their reopening measures. So this economic recovery could lose some momentum, and uncertainty around the path of the virus and the political outcome here in Q4 with the election with Trump and Biden is going to kind of linger on the markets as we move forward in time. For our members, we will definitely be up playing that market come election night, as we did Trump and Clinton. And we also did the same thing with the Brexit move as well. But we're also seeing low interest rates and strong monetary and fiscal stimulus helping sustain some of this economic recovery here this year going into 2021. Okay, so it's kind of the range of outcomes can be fairly wide here as we go through this the second half of 2020. So there's a lot of roadblocks out there, as well as this wide range of outcomes, both bullish and bearish. And this is going to help explain some of the elevated volatility levels that we're seeing right now in the VIX. And you can be an investor, a bearish investor, and make a solid case for a bearish scenario. But likewise, you can also make a solid case for a bullish scenario as well if you're a bullish investor. So, we're going to see this year's prevailing conditions kind of persist, like the COVID issues, low interest rates, very supportive monetary fiscal support, as I said. So we're going to see that kind of maintain itself as we go through the second half of this year. The other thing is Q3, I'm seeing signs that quarterly GDP for Q3 is just going to be a huge move higher, which is going to show and reflect rather the transition from the economy being completely shut down to reopening, although it's going to drag on a little bit longer than we thought. But we're going to see this initial rebound kind of from a spurt of pent-up demand as portions of our economy reopen. And that's going to be aided, of course, by government payments, fiscal stimulus, along with the central banks and what they're doing to kind of help spike and fill the gaps of unemployment. Really some of the highest unemployment we've seen since the Great Depression. So Q3 should be a pretty good jump higher, but then it's going to start to gradually pace down and slow down a little bit going into Q4 and then into Q1 of next year. And like I said, we got a wide range of outcomes depending on where the elections go and what we see with a possible prophylactic drug or a vaccine for COVID. So there's a lot of different directions this market can take, which again, as I said, is kind of one of the reasons why we got such a high vol level as we got right now. Now, the other thing that we've got coming up is we're going to have second quarter earnings kick off this next week. Banks are going to be in the spotlight. So far, for next week, we'll see about 8% of the S&P 500 companies report throughout the week. Okay, we're also going to get some important inflation data on Tuesday and retail sales Thursday. Housing starts on Friday, but folks, the big news is going to be watching the bank earnings coming out. I mean, we've got Citi, J.P. Morgan, and Wells Fargo coming out after market on Tuesday. Wednesday, we get Bank of New York, Goldman Sachs, PNC Financial, and U.S. Bancorp on Wednesday. And then Thursday, we get Bank of America and Morgan Stanley. So we've got a huge number. And then to close out the week, of course, we got BlackRock and State Street. So we've got a lot of banks and financial institutions reporting this week. So it's going to start to set the stage of where we're going. Now, most of the corporate earnings in Q1 got a pass because of COVID. A lot of them didn't really get a lot of guidance, but I don't think they're going to get as easy of a pass this time around. So we've got to watch the markets and see how they react to, is it good news or is it bad news? And we're going to set this stage this coming week. So what I want to do is I'm going to shift over to the charts here for just 1 second. So let me just move my screen around and let me just take it over here to, let's get over here to the S&P 500 E-mini futures. I'm going to have up here on the screen here, you're going to see as it paints on the screen here for you, the Fibonacci extensions off the pivot lows that we had on March 23rd. Now I've shown this chart ever really since we've pivoted off the lows here March 23rd. You can see these lows. You can see down below the pre-Brexit vote where we were, and then the overnight Trump election lows at 2028, and then the post-Brexit vote down here. So we've got a lot of support down beneath. But as I've told you guys in our weekly roundup, I think the lows have been made. The minute we moved over 61.8% fib node, when you move over that node, at least looking back at every bear market that we've had since the 40s in the US, you're going back, what, about 80 years, 8 decades? When we've gone up over 61.8% fib off the extension lows in a bear market, we've never made new lows. Doesn't mean we can't pull back, but we never made new lows, okay? Now, if you look at the markets right here, I'm just going to blow it up again. I got a couple things on the screen I just want to explain to you. We'll focus on this because the markets are kind of tailored in here. You can see the first things, we had the 50 cross the 200. Now, this is an SMA. The EMAs, they crossed back in early June, but the SMAs just crossed. Notice here on the 78.6 fib node, it's just, this has been, as I've been telling our members, in our group, this is a tug of war. I mean, just a big tug of war going on right now. And I said if we close above that and then we take out these highs, and we're right at the highs because we closed at the highs on Friday. If we can take that out, then we're probably going to move into the green because that's the line of demarcation between being in the red and being in the green for this year for the E-mini futures, okay, 32.36. You can see I've got a targeted Elliott Wave 5 pattern up here around 33.20, okay? So that just means that right now, for those of you Elliott Wave enthusiasts out here, we've had a Elliott Wave 4 pullback. Now, right in this area here, I was having our members get short with puts. I am, as I told our members, what if this becomes the support zone, then we're going to go up and we're going to take out the line of demarcation between green and red for the year. These are the all-time highs up here, and notice my target doesn't get us up to the all-time highs. You know, if we take this out, as I showed you, the short interest in the S&P rose 2%. In Nasdaq, it rose 5.02%. That's a huge bump on a weekly short interest, and that tends to create the FOMO environment where people are, you know, buying to close their short positions as they get run over, and it tends to accelerate the move to the upside for the near term. But it does set the market up for a pretty good little pullback. So if we do pull back, this is going to be our first level of support. The second level is going to be the cross of the 50 and the 200. That tends to be a very popular resting point, either resistance or support, depending on which direction the market is moving. So this is kind of at 30.23 right here, and then down below is going to be the 618 at 29.30. Now I've been telling our members that going through the end of July into August, remember July is one of the worst performing months of the year, statistically going back 2 or 3 decades for the S&P. And so I have been calling for a pullback in the month of July into August, somewhere around this area here, and then the low point would be down around this area here, 27.85. So call it 2800. You can see that we've got a lot of volume right here. So there's a lot of buyers hanging out right here. And should these buyers lose control, we're going to come down, test this, and then quickly come down and find ourselves down here. But like I said, there's a wide dispersion of choices going into the second half, and Q2 is going to play a huge role as to what the expectations are going to be, as well as the COVID-19 and these number of new cases coming up from California, Georgia, Florida, Texas. And, you know, is it going to, you know, shut the economy back down, which I don't believe. I believe the economy is going to stay open, but it's just going to slow the opening of a lot of businesses. So it's going to slow the recovery period. But, you know, clearly the markets don't play where we are right now. They play on expectations, and the markets have got strong expectations that either a vaccine is going to hit the markets in the next 3 to 6 months, and or the openings are going to be come in a lot better. So that sets us up for some downside surprises. So we need to be aware of that. Okay. So this is kind of what we're looking at on the E-mini S&P 500 futures. Now, what I wanted to show you here, let's show you Nasdaq, because Nasdaq is just truly on fire. And if we come in here and let me just get Nasdaq up on the screen for you here. You can see on Nasdaq now, we made new all-time highs on Friday. And on Nasdaq, I've got the Fibonacci retracement versus extensions. And you can see this first retracement level slightly under the 10,000 area. And you can see on that retracement, I mean, you can see all the buyers right here. This is volume over price. So the buyers are just sitting right at this level here. So if we do get that pullback that I'm looking for, then buyers, we can expect very strong support there. You can see the 50 SMA and the 200 SMA sitting here. But you can see just how far off of the closing price of 2019 we are. That is why we're, you know, over 18% in the green year to date for the Nasdaq. But you can just see this huge move higher. Look at the MACD. It is flat. It hasn't gone anywhere. So there is no place else for money to go, and we're seeing a rush here, which is why we're seeing short interest go up, which is probably also goosing the market up a little bit higher because a lot of people are trying to short the market, more weaker hands trying to short the market, and they're getting run over, just totally run over by the market. And then what's happening is they're having to buy to close their positions, and that creates, another move higher. Now, if I were to come in here and let's put it on a weekly chart, you can see on this weekly chart that I've got imprinted up here a possible much stronger resistance point right around 11,600. Okay, now we're sitting at 10.8, so that's about 800 points higher from where we are right now. And if you look at these movement off the low, you can see here these weekly bars. There's only been just a few weeks where the Nasdaq has moved down, and even then, there's just not very many red bars on the week, and it's just very strong movement. So I am expecting a little bit of easing here, but we don't get really some of the big earnings for another couple of weeks into Q2 earnings. So we're going to get a little bit of prescription of what's going to be happening with these tech stocks as we go through this. Now, if I put it on the daily chart, you can see that support zone right here, this resistance zone rather, up in this area here. We're on a 3-leg, so a 3-leg is the biggest long impulse move higher, and typically on a 3-leg we do get a 4-leg pullback. You can see the system guesstimating a pullback into this 9,500 zone all the way up to about 99, so let's call it 10,000. So 10,000 and 9,500 would be an Elliott wave 4 pullback before it starts to come back up and make new all-time highs again. So we've got to be very careful in these markets. Now, the other thing I wanted to show you, let's go take a look at volatility. The interesting thing, most of the markets this week were in the green for the week, with the exception of the Russell. And if I come over here and let's get the volatility chart up for you guys. The interesting thing with volatility, if I put it on a weekly basis, and it'll paint the screen here in just 1 minute, you can see it was slightly flat. I mean, almost closing slightly lower than where it closed the prior week, okay? But we're still elevated, all right? So vol closed at 27.29. So we're still in the upper 20s. And the reason why it's elevated like this, now remember, I told our members, I told you guys also, once we got them into this black swan zone area, because notice I've got it color coded, up in this area here, then vol is going to stay elevated for anywhere from 6 months to a year. Okay. Remember, in 2008, vol stayed elevated over a year and a half before it finally came down into the teens. Every time we get down here, we're going to have an event that's going to move all up really quickly because the markets tend to be more sensitive after an event like we had in March. So if we come back to the daily, you can see here where the markets have just been, or vol has been very choppy from the solid red zone into this rose colored zone. So that just, these colored zones just give us some idea and prescription of different kinds of option strategies that we want to play. If you're not a member by group, I highly encourage you to come in because we had a great year last year. This year we're doing well. We got some trades on and strategies that actually have been making really good money this year, including during the drop. So we're running these, a lot of different ways to do this. Now, there's a really good article in Barron's this weekend on hedging your portfolio. And a lot of traders just immediately think of, especially options traders, immediately think, I'm just going to go buy some puts. But the thing about puts is it's a big drag on the portfolio. There are other ways that you can hedge your portfolio, which we go into in our group, that are not as costly. In fact, you can make money on the hedges by doing these things. So again, if you really want to learn how to use options and play volatility and learn how to hedge at a much lower cost than just picking up long puts, this is kind of where you want to be. And right now with vol elevated, you're going to be paying more money for these puts, especially as we get through the second half of this year going up to the election. You're going to see vol stay elevated. So you need to learn how to play that kind of market. If we come down here and we look at treasuries, and I'm going to show you here the bond market. The bond market came down about 27 ticks, but if I kind of step it out a little bit, you can see here with the bond market, we've been in this tight range really since the market started to crash. Now, this is a manipulated market right now with the Fed's doing what they're doing. They're kind of manipulating the yield curve, the 2s over 10 and the 3s over 10. That would be the 2-year over the 10-year. and the 90-day over the 10-year. And they're manipulating that market a little bit right now, but you can see where we've been sitting here. And throughout the course here, these have been great option trades if you wanted to put on some iron condors or doing some of the things that we've been, I'm teaching our members in, ratio diagonals and things like that. These things work out really well when you've got the bond market staying roughly range bound, okay? And if we look at AGG, for those of you that are into hedging the market, AGG basically is an aggregate bond fund. Now, notice here how it just came hard down, all the way down here. A big move with March. Remember, bonds did the same thing. If we go back to the bond market, you can see here in the bond market, if we look at March, how bonds came down hard right here as everybody was selling everything. They were throwing the baby out with the bathwater, and then finally they reversed back up. Because what happens and what people don't realize is that when the markets have a sudden surprise move lower, it's hard where you're met with back-to-back and week-to-week red candles solid down. Everybody is selling everything, including risk-off assets, until we start to get near a bottom. And that's where it's really good to be picking up some of these risk-off assets because they bounce back very quickly. So if we go back to AGG, which is a bond fund, you can see here how it racked down really hard in the month of March, and then it came right back up. AGG is also a good place for those of you that are into mutual funds or you're into stocks. It's just having part of your portfolio because it's the year to date, it's up a little over 6.5%. So it's doing much better than say the stock market, and it's a less expensive way to hedge than say just buying long puts, unless you understand how to play the option market. Okay, now if we come over here and we look at currencies, longer term, I'm going to be very bearish the dollar. You can see here how the dollar has dipped below its 2019 close price, which means the dollar would be in the red for the year. You can see the dollar moving up huge during that crash, okay? Everybody wanted to hold dollars, including a lot of foreign banks. And then when the Feds came out and did their reverse repo swaps with foreign banks, then you can see where they were selling dollars, the Feds did, to foreign banks because they couldn't get their hands on enough dollars. Then that drove the dollar back down again. So any of these anomalies here, when you have these kind of markets like this, guys, you got to be available to take advantage of them. All right. Now, if you can't trade the US dollar, the same thing happened with the euro, but only in reverse. If you look at the euro, you can see in March how the euro just shot down on the initial shock of the markets going down, and then it reversed back up when the Fed stepped in and started doing their reverse repo and selling dollars. And then you can see the euro come right back up. Longer term, I think the euro is going to break out of this range. You can see the bullishness going into this range, and then it's going to move back up into the 115s again longer term. Should we have that pullback in the latter part of July and August, then wait for the euro to dip, the dollar to get stronger, and then on that reversal note, that's when you're going to want to step in. For our members, I'll go into more detail with you this Sunday evening. On these. The British pound, they got more issues than you can imagine. Down in the lower area down here with the British pound, you can see I was having our members pick up longs. I mean, the British pound down around 114. I mean, that's just low hanging fruit. You gotta be long either Foxtrot, X-Ray Bravo, FXB, or looking at the British pound to the upside because it's just a complete overshoot to the downside. Okay, I mean, just a complete overshoot. When the markets crashed in March, towards the end of March, I came out with a list of securities for our members to pick up. Every single one of them is just up very strong, anywhere from 60 to 70% to over. In fact, we got one security that's up 2,600%. Really crazy. But these are just some of the things that you want to do when you get these market dislocations like this. Just hold your nose and you got to do what you got to do. But that's where the currency market is right now. The British pound, they got to come to terms on the Brexit. If they don't have anything done by October, they're either going to do a hard Brexit or they're going to just agree to delay again another year. And I don't think Boris Bulldog Johnson wants to do that. So we're going to come to loggerheads here shortly with the British pound to see where we want to go. Okay, that will affect the dollar. The reason why the British pound is about 11.9% of the value of the dollar index. The biggest percentage of the dollar index is the euro. It's 57.6% of the dollar index. Remember, it's really not the US dollar, it's the dollar index because it moves according to the cross currency exchange rates of the euro, yen, pound, Canadian dollar, Swedish krona, Swiss franc. Each one of them has a percentage stake in the US dollar index, and that's what drives the dollar index. So what you've got to do is kind of like driving with a rearview mirror. You got to follow where the euro is going, the yen, the pound, and that'll help you with the dollar. Now, if we look at metals, let's look at gold. As I said, gold hit highs that it hadn't seen since 2011. And if I just move it in here just to get the highs in there, you can see 1829.80. We haven't been up there since 2011. You can see this move up, but it is an Elliott Wave 5, okay? So I do believe gold is going to pull back a little bit. Now, I think longer term, gold is going to make a nice run for it. But right now, if you're not in gold, I wouldn't chase it, all right? I just wouldn't chase it. We got a poor man's bed setting up. Members, you know what that means. If you're not a member of our group in this, buds, beds, these are great high probability trades that you need to understand how they do. And you just want to follow those kind of trades. But this is kind of where I'm looking at with gold right now. And there are several other ways to play gold if you're not into this one. Energy, let's look at oil. Oil had a nice day on Friday. It was up over $1. We went long oil back after the zero rate got penetrated, which I never thought would happen. I mean, who knew, right? If you were to ask traders in January, could oil go below zero? I mean, you would think logically and say that's impossible, right? And this is what it did. It went below zero. And there were a number of reasons why. I'm not going to get into it in this weekly update session. Our members understand why in full detail why. But you can see where oil has now moved up above a key resistance point. Is now going to serve as support. I do believe oil has a propensity to get back up into the 50s and 60s. We're playing long oil. Members, we'll go into this in more detail this weekend as well. You do not want to be in USO to play it. There are a couple of oil stocks I think that are also really good. Chevron and Exxon. Chevron is a little bit better. It's got a better balance sheet than Exxon. Paying a nice little dividend, a little over 4% for Chevron. And you can see on this pullback here, be kind of a buy the dip kind of thing. Okay. Exxon, it's not quite as bullish as Chevron, but it's coming down to a key support level, and it pays a little bit more in dividend because their balance sheet's not quite as strong, but believe me, they're not going out of business. So it's another one that I would look at. Let's look at nat gas. Nat gas, there is a huge inventory of nat gas out there, but down in this area down here, I've been suggesting bull put spreads. Okay, so they're credit spreads. And there's just quick income kind of trades. We came below here on an inventory surprise this past Thursday or a week ago, but I knew it wouldn't last. And that would have been another beautiful point to just put this thing in. Now, a lot of the big money is forecasting nat gas to come back down to the 1.4 area. I don't think nat gas is going to get too far up above here. If it does get up in this area, then I'd flip over from bull put to bear calls, right? Just keeping it in the credit spread family. And just playing these things here. You don't want to trade UNG. I'd stick more with the nat gas futures. You can do a very tight spread. Excuse me, and do well with the money on it. So this is kind of where we're sitting for the week, guys. Members, I will see you this Sunday evening. We're looking at an option masters coming up. It'll be fun. I keep swallowing my coffee the wrong way, guys. Otherwise, everybody, I will see you for our next free weekly update next weekend. Take care, everybody. Ciao.